Hello and welcome to the Tax Roundup for December. Inside this month, we're going to take a look at the recently announced changes to the instant asset write-off rules that were enacted from the federal budget. We're also going to take a look at a piece of legislation that deals with the tax-free status of state and territory COVID-19 relief measures. But first up, let's have a chat about JobMaker. Now, JobMaker is going to be complex to administer, the rules are difficult, and details are very scant right now. And on top of that, the first period to elect to be a part of the JobMaker Hiring Credit ends on 6th of January 2021. Across to Michael for the details.
One of the other things that was announced in the most recent federal budget was the JobMaker Hiring Credit scheme. At a really high level, this is, I guess, going to take over to some extent from the JobKeeper scheme, although the two will run in parallel for a period of time. Now, the JobMaker Credit scheme, really the purpose of this update is to kind of bring you up to date in terms of where it's at for the time being, because we're not quite there yet. The rules themselves will basically be kind of broken down into a few different parts. First of all, there's some legislation that kind of enables this scheme to operate. Now, that has passed through Parliament. So the starting point is that we've got some legislation that's gone through Parliament that allows this scheme to operate. But that doesn't really tell us a whole lot, because a little bit like the JobKeeper scheme, the real detail of the rule will be provided in legislative instrument that's issued by the Treasurer. Now, that hasn't happened yet. Treasury has released a draft version of those rules for public comment and consultation. The end date for that is 27th of November. We expect that Treasury will then have to collate and review and read and decide what to do with the submissions that it receives as a result of that consultation process. So it may be a little bit of time before we then see a final version that is released by the Treasurer in terms of that legislative instrument. It's the thing that actually tells us what we need to know in terms of how those rules will actually operate. Now, again, if you think about timing-wise, we've got Christmas coming up pretty soon. A lot of people are going to be on leave and out of the office, not doing things as normal for a couple of weeks around that time. That's going to create a few practical issues. One of the reasons why there's going to be a practical issue is the first deadline, as per the draft rules as they stand at the moment, for enrolling with the ATO in the JobMaker Credit scheme is the 6th of January 2021. Now, I don't know what you're planning to be doing on the 6th of January, but I know a lot of people are going to be sitting on the beach or watching some cricket. They're not going to necessarily want to think about JobMaker. But there's a couple of things just to remember around that. First of all, that's a draft deadline in some draft rules. But I suspect that probably still will technically be the first deadline. Second thing is the ATO has the power to extend that deadline. Now, we haven't seen anything just yet on that. We're hoping that the ATO provides some extensions to a number of deadlines, not only this, but also maybe around JobKeeper as well, just to take into account the disruption that happens over the Christmas period. But again, we've got to wait and see on that one. The third thing is that you don't necessarily need to do a lot by the 6th of January. You need to enrol with the ATO, but in terms of actually lodging probably detailed information with the ATO and actually making a claim under the JobMaker credit system, that probably won't happen until later in the year, probably around the start of February. So probably between now and the end of the year is this time to start thinking of those clients who may well qualify for JobMaker. Even if you're not 100% sure, you might reach the point where you decide with the client that it makes sense to at least enrol in the scheme and then do a bit more of the detailed work in the new year to see whether those credits are actually available or not. Now, if you miss that enrolment deadline, as I said, possibly the ATO will extend it, so that might help. The other thing is, it doesn't mean you can never enter into JobMaker. It's really just the deadline for the initial 3-month period of JobMaker. So there'll be probably a whole bunch of clients who don't qualify for that first 3-month period anyway. For example, because they're receiving JobKeeper, which for many people will keep them out of JobMaker. So people will be able to enter in later on, but it could have an impact in terms of the total dollars they claim back from the ATO. So again, don't just figure that it's all a bit too hard and we'll just wait. It may mean if you wait, clients miss out on some money that they might otherwise be entitled to. So some high-level work probably does need to be done over the next few weeks in terms of identifying clients who might be eligible for those who might be eligible may be worth enrolling once the ATO has that facility up and running. Now, the other bit around this is that it looks like the Commissioner will also have some power in terms of how the rules work in certain areas, in terms of information that's given to the ATO, that sort of thing. Again, we haven't seen that sort of detail as yet. That's something, again, that the Commissioner will probably provide through a legislative instrument or determination, probably after the Treasurer does that. So there's a few series of steps that need to happen before we get the full picture of JobMaker, but the draft rules give us a picture, at least a high-level indication of how this might work, and we can start thinking of clients who may qualify and those who might want to enrol by the 6th of January.
If you want to help your clients access JobMaker, join us on Monday, 14th of December for the JobMaker Hiring Credit Essentials webinar. If you're a member, don't forget to log in to get your discounted rate. On the 23rd of November, the Treasurer announced some changes to the recently enacted instant asset write-off rules, extending the program out further. Across to Michael for the details.
One of the major changes that was announced in the most recent federal budget was the expansion of the instant asset write-off regime, basically to cover entities with aggregated turnover all the way up to $5 billion, and also introducing, I guess, a no cost limit immediate deduction. So rather than the $150,000 cost limit that we had, we're moving into an environment now where we have the ability to write off assets regardless of their cost, as long as the relevant basic conditions are met. Now, those changes were rushed through Parliament very soon after the federal budget, and they really haven't been in play for very long, and it looks like they're going to change already. What the Treasurer has announced is that two main changes will be made to those rules. The first change will basically allow some Australian entities that are part of large global groups to still have access to this measure. The concern, I guess, was that some Australian companies that may be connected or related, grouped with some overseas entities, would fail that $5 billion aggregated turnover test because the operations of the worldwide group have been included in that turnover test. Well, the Treasurer says that that is going to change and an alternative test will be introduced so that some of those companies who are affected by that can actually access these concessions. So that's the first change. Some companies that actually do have aggregated annual turnover of $5 billion or more will be able to access the concessions. Now, the second major change is probably more relevant to, I guess, a broader spectrum of business entities, and that is one of the features of the instant asset write-off rules historically has been that the rules apply pretty much on an automatic basis. If you meet the relevant conditions, then you get the instant asset write-off, you get the deduction for the cost of that asset immediately without a whole lot of choice as to whether you take it or not. Now, for some people, that's actually not a great thing because deductions end up going to waste maybe this year when they would actually be better used being spread out over a number of years. Particularly for some smaller businesses, that can be a bit of an issue. So what the Treasurer has announced as part of the second change that will be made is that entities will have the opportunity to opt out of that instant asset regime. Now, it remains to be seen exactly what the detail of that looks like. For example, the low pool value rules for small business entities. One of the changes as a result of the recent budget amendments is that pool balances for SBEs are written off in full in the 2021 year and 2022 year, regardless of the pool balance for those years. Well, it remains to be seen whether this opt-in or opt-out ability will extend to those rules, because again, that has been something of concern to some smaller businesses where they are having to write off for them reasonably large balances, say this year, where for tax planning purposes that may actually not be ideal for them. So we'll have to wait and see. This is just an announcement at this stage. Some legislation will presumably be introduced to Parliament in the relatively near future, although with Christmas coming up, we'll just wait and see how that plays out. So some changes. We've got these new instant asset write-off rules that basically apply from the 6th of October this year onwards through to the 30th of June 2022. But just keep in mind that there are already a couple of announced changes to be made to those. Just keep that in mind as you're having those discussions with clients over how these new immediate write-off rules actually work.
Now let's clear some of that confusion over the tax status of the state and territory COVID-19 relief measures.
Now, prior to the most recent federal budget, the Prime Minister came out and said that certain state government grants or payments relating to COVID-19 to business taxpayers would become tax-free. We now have some legislation that's been passed in relation to that, but there are some crucial things to bear in mind before we go out and tell our clients that some of the money they've got from the government is tax-free. The first thing is that only specific state and territory government payments will qualify for tax-free treatment. There are a number of conditions that need to be satisfied in order for that tax-free treatment to apply. Now, one of the main conditions is that the minister needs to actually make a determination or a declaration that specific state government payments qualify for this tax-free treatment. And there's a number of things that the minister has to take into account in making that declaration or decision. Now, from a practical point of view, one of the things that needs to be taken into account is when that state government or territory government payment was announced. Tax-free treatment will only be available to state government payments that were announced on or after the 13th of September 2020. Now, that happens to be the date that the Victorian government announced a series of payments, and it's those ones that are most likely to be made tax-free initially. But again, we still need to wait for the minister to make that declaration. From that point onwards, it's up to the state and territory governments to actually make basically an application to the minister to seek to have certain payments made tax-free. Then the minister's got to make that declaration before they become tax-free. So this is likely to cause some confusion because clients might hear that some state government payments are now tax-free, but it is likely to be quite limited and quite targeted at very specific types of payments. Certainly those that were announced and paid prior to the 13th of September this year, they doesn't really look like they could possibly be tax-free. If your client's running a business, they've received a payment from the government relating to their business activities to help support them in their business activities, those payments are very likely to be taxable to them unless they fall within the scope of this new exemption, which is likely to be very limited. The other thing is that there's a time period that these payments basically can be tax-free for. So 13 September 2020 is kind of the start date of this particular change. Payments have to be received by 30 June 2021 to qualify. So we're talking about a limited number of payments covering a very limited period of time that will be tax-free. Just remember that pretty much all other state government payments will probably end up being taxed to your business clients for the most part. So good news for some clients receiving certain types of payments, but it probably doesn't change as much as what some clients think it might. For those other payments, again, probably taxable, and we're just going to keep that in mind because from a cash flow point of view, that is likely to have a pretty significant impact on some of our clients.
And that's the tax roundup for this month and also this year. I'd like to wish you a safe and Merry Christmas. But before we go, we do expect there to be a series of tax rulings and other announcements made prior to the end of the year. We'll keep you abreast of those changes on Knowledge Shop's Twitter account. Just see Knowledge Shop AU. If your firm is not a member of Knowledge Shop as yet, then give the team a call on 1800 800 232. We'd love to show you how we make the lives of accountants and advisors across Australia just that little bit easier. See you next year.